Alternative energy midcaps, ranking the field by quality, growth, and valuation by value and momentum portfolio. Today we're going through 15 alternative energy names, mid-cap stocks across solar, hydrogen fuel cells, energy storage, ethanol, even isotope enrichment. We ran all 15 through the same three tests we always use: quality of the business, growth, and valuation. Then we put our usual momentum check on top. Now here's the thing to keep in mind from the start. This is a theme, not a quality basket. We group these names because they sit in the same corner of the market, not because they're all good businesses. And the screen makes that very clear, as you'll hear. Quick note before we start. This is for information only. It's not investment advice. All the figures are as of the 7th of June, 2026. Let me give you the most useful finding first before we even get to the ranking. We hold every name to one opening test. It's simple. Is the business profitable? And does it actually generate free cash flow on a trailing basis? That's the gate. Both boxes have to be ticked. Out of 15 companies, 2 pass. 2. Think about that for a second. Roughly 87% of this field fails the very first filter. So this exercise isn't really about finding great compounders. It's about separating the 2 or 3 real businesses from the cheap melting ice and from the story stocks. Let me walk you through how we score each name. There are 3 axes and we combine them. One thing to understand, every score is a percentile rank inside these 15. So it tells you how a company stacks up against the others in the basket, not against the whole market. Higher is better. First axis, quality. That carries 40% of the weight. We look at returns on capital, returns on equity, net margin, free cash flow margin, and how much debt sits on the balance sheet. The question is plain. Does the business turn sales into cash? Does it earn a real return on the capital it uses? And does it avoid funding itself with debt or with constant share issuance? Second axis. Growth, 30%. Forward revenue, the 3-year revenue trend. Forward earnings growth and trailing revenue. We cap the trailing figure on purpose. Otherwise, a handful of these names show 4-digit growth rates, and that's only because they're lapping almost no revenue from the year before. The cap stops that from distorting everything. Third axis, valuation, also 30%. Enterprise value to sales, enterprise value to EBITDA, forward price to earnings and price to cash flow. Cheaper ranks higher, but, and this matters, we report it mechanically and then correct it by hand. Because in this group, a low multiple is usually a warning, not an opportunity. Then on top of all that, the momentum overlay. Our standing rule is this: when the market refuses to reward a thesis, that refusal is itself the most useful signal you get. Price confirmation doesn't create quality. But if a cheap name has no price support, it usually means the market is pricing in a problem the screen hasn't caught yet. So, we check price against the 200-day average, we check the RSI, and we look at the 1-year return. And one last layer, analyst price targets. We report them, but we keep them out of the score, on purpose. Because in this basket, the implied upside runs almost backwards. The most upside sits on the beaten-down names and the pre-revenue stories. So it's interesting context, but it doesn't belong inside a quality ranking. The ranking, so who comes out on top? At number 1 on the raw composite is Toyo, a solar cell maker. It scores 93 on quality, and it lands at 84 overall. We've labeled it quality with an asterisk, and we'll get to why. Number 2, Fluence Energy, the storage business, at 66. Cheap, growing, but not yet generating cash. Number 3, Rex American Resources, an ethanol producer, at 62. We've called it the clean compounder. After that, the scores drop into the 50s and 40s. T1 Energy, Canadian Solar, Green Plains, Jinko Solar, Shoals, and on down through the burners and the loss makers. Right at the bottom at 32 is ASP Isotopes, the most expensive name in the basket, and it's burning cash. Now here's the honest part. The mechanical ranking over-rewards 2 things, and we wouldn't publish it raw. It rewards cheapness even when revenue is shrinking. That lifts the tired solar names, and it rewards base effect growth, which lifts the story stocks like T1 and EOS. So the tier labels are where we apply judgment. On a quality-adjusted basis, the top really tightens to just Rex and Toyo. Most of the optically cheap, high-growth names lose conviction, even where they hold their rank on paper. One more piece of context. This whole basket has already re-rated hard. 11 of the 15 are up double or triple digits over the past year. Several are up 4 or 5-fold. So when we say something looks cheap, remember it's cheap after a big move, not before one. Quick word on what the street's price targets say, because they cut two ways. The analysts agree with us most at the bottom. Fuel cell energy, for example. Consensus there implies roughly 58% downside. That's the loudest agreement with our ranking anywhere in the table. But they disagree with us most on ASP Isotopes. Two bullish firms put implied upside at about 109%. On the name our own work ranks dead last. And that right there is exactly the kind of optimism our quality gate exists to resist. And watch Toyo. It's the cheapest growth in the basket on a multiple. Yet it sits only about 5% below the street's targets. Why? Because the price has already run up to meet them. So implied upside is not the same as quality. That's the whole reason we keep targets next to the ranking and not inside it. Now let's get to the part I think matters most. The reverse discounted cash flow. Here's the idea. A multiple tells you what a company costs. It doesn't tell you what has to go right to justify that cost. So for the two names that actually generate free cash flow, we ran the question backwards. We held the discount rate at 10% and the terminal growth rate at 2.5%. Then we asked, what rate of cash flow growth does today's price already assume over the next 10 years? Let me give you one reference point that makes everything else click. At those settings, a stable business whose cash flow never grows is worth about 11 times that cash flow. So anything trading above that line is priced for growth. Anything below it is priced for decline. Hold on to that. 11 times is the no-growth line. Now Toyo trades at about 8 times free cash flow. That's below the line. So at today's price, the market is pricing Toyo's cash flow to shrink, not grow. The implied 10-year growth rate is negative, somewhere around -5% a year. Think about that contradiction. This is a company that just grew revenue over 200%, and yet the market is pricing its cash to decline. So which is it? Either the cash flows are real and durable, and the stock is genuinely cheap, or the market is right to discount them because the durability is in doubt. The multiple isn't the debate. The durability of the cash is the debate. And that durability question now has a problem attached to it, a going concern flag and revenue that mostly comes from one affiliate. Those are not the hallmarks of cash flow you'd extrapolate with confidence. Now Rex, the opposite situation. Rex trades at 16 times earnings, which sounds cheap, but on free cash flow, it doesn't look cheap at all. It trades at roughly 60 times trailing free cash flow. To justify that, the price assumes free cash flow growth of about 23% a year for a decade. That's a demanding number for a commodity ethanol business. So how do you reconcile 16 times earnings with 60 times cash flow? Cash conversion. Rex turned only about a quarter of its net income into free cash flow last year. A 14% net margin became a free cash flow margin of under 4%. Now, one fair caveat. A single year of cash flow for a cyclical processor is noisy. That $24 million in free cash flow might be a trough. If normalized cash flow sits closer to earnings, the multiple compresses back towards 16, and the implied growth becomes ordinary. The point is, Rex's cash conversion, not its earnings, decides whether it's cheap. And why do we stop at just those two? Because a reverse DCF needs cash flow to discount. 10 of these 15 names have none. They burn it. You can't grow a negative number into a justification. So for those names, there's no implied growth rate. There's only an implied article of faith. Where there's no free cash flow, valuation isn't really analysis. It's a forecast wearing a multiple. One more test, quickly. The cleanest test of whether a business creates value. Does it earn more on its capital than the capital costs? Against a 10% cost of capital, only two names clearly clear the bar. Toyo's return on total capital is about 27%. Clears it by a mile. If the figures are real, Rex is the interesting case. Its reported return on total capital looks low, around 6.5%, but that's depressed by a near net cash balance sheet. There's a big pile of cash sitting in the denominator. Adjust for that cash, and the operating business clearly creates value. Everywhere else, the question is moot. Return on equity is positive only at Rex and Toyo. It's negative at every loss-making name in the basket. And a company losing money is destroying capital while it does it. Same dividing line as the profitability gate, just said in a different language. So let's talk about the two that actually pass. Tier 1, first Rex American Resources, the clean compounder. It's a profitable ethanol producer with some optionality in refined products and carbon capture. Unglamorous, but it's the only business in the basket that funds itself. The balance sheet is a fortress. Total debt of under $20 million against a business doing $656 million in revenue. That's effectively net cash. The shares are at just under $45. Net income of about $93 million. Net margin around 14%. Return on equity just under 16%. Earnings per share grew more than 70% off a strong crush environment. Two cautions on those earnings, though. The most recent quarter posted a net margin near 28%, way above the trailing 14. That was flattered by a strong crush spread and by clean fuel tax credits. So this year's earnings probably sit above a normal level. And that cheap-looking 16 times multiple rests on a base that may be too high. The momentum case is constructive. The stock trades about 22% above its 200-day average. It's up over 110% in the past year. RSY is around 39 after a pullback, so the trend's intact and it's not overbought. And it has the lowest beta in the whole group. The bull case is simple. Quality, no dilution, 16 times earnings, with optionality the market isn't paying for. If ethanol margins hold, it compounds quietly. The bear case. It's a low-growth, low-multiple commodity processor. Quality with no re-rating catalyst can be dead money for years. You can be right on the quality and still wait a long time to get paid. And remember the cash flow point. Cheap on earnings, not cheap on cash. Now Toyo, best on paper, going concern flag in the filings. It's a solar cell and module maker, only incorporated in late 2022. Plants in Vietnam, Ethiopia, and Texas. The Texas line only started up in October of 2025, and the structural catch is right out in the open. A majority of its revenue comes from a single affiliate, a company called Vision. On the numbers, it's the best operating profile in the basket on every line. Return on equity just under 70%. Return on total capital around 27%. Revenue grew over 225% year on year. The shares are near the top of their range after a very big run. But here's a pattern worth naming. Toyo beats on earnings, and it misses badly on revenue. Recent quarters came in roughly 24 to 30% below revenue estimates, even while earnings beat. To me, that reads as weak forward visibility, not conservative guidance. The bull case. At 7.5 times earnings for a business growing triple digits, if the numbers are real and durable, it's the cheapest growth in the basket by a wide margin, and the reverse DCF sharpens it. At 8 times cash flow, the market's pricing the cash to decline. So even flat, durable cash flow would justify a higher price. But the bear case is heavy, and it's why this one carries an asterisk. The auditors flagged going concern doubt. There's a working capital deficit of about $124 million as of December. That's a solvency question, and a 70% return on equity completely masks it. Most of the revenue comes from that one affiliate, so the headline growth is concentrated related party revenue, not a diversified order book. Third-party customers are growing, but off a tiny base, and the tariff exposure is severe. A 271% anti-dumping rate on Vietnamese solar cells. Now, none of that condemns the business outright, but put it together. Going concern, affiliate-dependent revenue, a punitive tariff regime, and a Texas line only a few months old. That's more than enough to keep Toyo out of a quality sleeve until the picture clears. On the numbers, it ranks first. On the evidence we now have, it hasn't earned the conviction that ranking implies. The asterisk has become a warning. Tier 2. Three names with real growth that hasn't turned into cash yet. Shoals Technologies. It makes electrical components for solar projects. It's genuinely net profitable, with revenue up nearly 38%, but free cash flow is negative. And you pay 54 times trailing earnings for growth that hasn't become cash. The valuation gives back almost everything the business earns. Array Technologies, solar tracker systems. This one does generate a little free cash, but it's still net loss-making, dragged down by leverage. The forward multiple is low, the PEG is under 1, the cheapest growth-adjusted multiple in the group. But here's the catch. The momentum's missing. The stock sits below its 200-day average and is down on the year. So it's a turnaround priced as if it's already turned, without the price action to back it up. And Fluence Energy, grid-scale storage backed by AES and Siemens. The structural position is real. A backlog over $5 billion, a big pipeline, deployments across 25 countries, sitting right in the path of the AI and data center grid build-out. It's the largest revenue base among the names that aren't yet profitable, and it's the cheapest on sales. It's right at the edge of profitability. Fluence also has a specific catalyst. On the 1st of June, a Siemens and NVIDIA AI factory partnership sent the stock up about 51% in a single day. That catalyst, not a fundamental turn, is what carried the price above the analysts' targets. The bear case is that storage integration is a thin margin, working capital hungry, competitive business, and the cash burn is real. Profitability there is still a forecast, not a fact. Tier 3. This is the cluster the mechanical screen likes, and we don't. Cheap solar and infrastructure names. The pattern's the same across all of them. A low multiple on shrinking revenue with no price confirmation. That's not value, that's the market pricing structural decline. Take Canadian Solar. Cheap on EV to EB, ITDA, and A+ valuation grade. But revenue's falling, there's a net loss, and it carries the heaviest absolute debt load in the basket. Same problem, same missing price support. Or Green Plains, it's the ethanol counterexample to Rex. Same industry, running the opposite way. Rex stays profitable through the cycle. Green Plains is waiting for the cycle to come rescue it. The one thing keeping it ahead of the pure traps is decent momentum. So the bottom line, Rex is the one clean compounder. Profitable, cash generative, effectively net cash in a constructive trend. It's the only name we'd underwrite on quality alone. The weakness is the lack of a re-rating catalyst. And keep the reverse DCF wrinkle in mind. It's cheap on earnings, but not on cash. So cash conversion is the thing to watch. Toyo screens best on every operating line, and it ranks first on the mechanical composite. But the filings have now answered the conviction question, and the answer isn't good. Going concern doubt, a working capital deficit, most of the revenue from a single affiliate. The reverse DCF already showed the market pricing Toyo's cash flow to decline. The filings suggest why. So that leaves Rex, not Toyo, as the one compounder we'd actually underwrite today. Toyo becomes a distressed turnaround option. Size it as one, not as a quality holding. Below them, Fluence, Shoals, and Array offer real growth that hasn't become cash yet. Fluence is the cheapest. Array is the most momentum challenged. And the optically cheap solar and infrastructure names are cheap because they're shrinking or over-levered. The market isn't rewarding a turn yet because there isn't one yet. That's the field. One clean compounder, one option dressed as a compounder, and a long tail the screen flatters and the evidence doesn't. A final reminder. Everything here is for information only. It's not financial advice. All the figures are sourced from public filings, current as of the 7th of June, 2026. This is institutional-grade research from a former Lazard and Rothschild banker. I'm Dennis. Each week, I bring sell-side rigor to fundamental coverage, paired with high-conviction momentum setups. If that's useful to you, come join the Value and Momentum portfolio. Thanks for listening.